Hi Brendan, how are you?
I'm doing very well, Mauricio. How are you?
I'm fine as well, thank you. Brendan, can you describe the current market environment in China? Please provide a brief review of the latest macro data, monetary policy action, and earnings outlook. Do you agree there may be a slowdown risk in the short run?
Well, defining China has always been a very critical part for investors. The definition of China for some investors might be the Chinese A share market, comprised of the stocks on the Shanghai and Shenzhen stock exchanges. Those markets this year are up slightly year to date. And we can contrast that with the performance of Chinese companies listed in the United States and in Hong Kong, which are down, upwards of 20% or more. And so I think it's very important for investors to understand this disparity between Chinese A shares, Shanghai and Shenzhen companies, and contrast that with Chinese companies listed in the United States and in Hong Kong. Now, what's driving this disparity is the investor base. That the Shanghai and Shenzhen stocks are predominantly owned by investors in China. And those investors see the Chinese economy is doing well. China's a beneficiary to the global reopening, and therefore that should be a good thing for stocks, for the underlying companies and their earnings. And so those markets have been very resilient. And we can contrast that with foreigners' view of China, that due to US and China political tensions, due to regulation of Chinese internet companies, both in China as well as in the United States, foreign sentiment looks very different. And that's driving the performance of those stocks lower, despite what we see as very strong fundamentals in the underlying companies. So it's a very easy question you've asked, Mauricio, and yet it can be difficult to answer because some investors in China might be performing very, very well. In the case of, say, China's new Star Board, that's up over 10% this year. And you can contrast that with investors in US and Hong Kong listed Chinese internet companies, which are down somewhat significantly year to date. And we do see that China's economy has been performing well. That performance is starting to slow. And part of that is just simply that economic data is reported year over year. So China finished its quarantine in the first quarter of last year. So the year on year comparison gets harder and harder because the kind of low bar of economic activity gets higher and higher. And for that reason, we believe that we're apt to see accommodative stimulus policies in China over the course of the second half of this year, which should provide some stability for the economy and therefore for the markets as well.
Okay, great. So let's talk about regulation. How deep can be government intervention and cause an extended overhang in the broad market? How can an investor navigate this market volatility?
Well, we believe that governments globally are increasingly looking at the regulation and supervision of, say, internet companies. We saw this in Europe back in 2018 with the GDPR, the General Data Protection Rights, which really focused on what do apps on our mobile phones, what are those companies doing with that user data? What are the rights from a privacy perspective? And China's heading down a similar path of basically saying that these companies, in the case of Chinese internet companies that we hold in our Crane Shares CSI China Internet ETF KWEB, 30% of all retail sales flows through the companies in KWEB. And who's supervising? Who's regulating them? What are they doing to protect their user data, their user privacy rights? So the market's been quite concerned about when does this regulation end? That it seems to be implemented in an ad hoc basis. That a new issue tends to arise almost on a daily or weekly basis, and we think that uncertainty has weighed tremendously on the companies At the same time, the earnings of the companies have been quite strong that we've seen in the Q4 earnings reported in February and March of this year. The companies were adhering and adapting to regulation, and the earnings looked fine. We saw this again with the Q1 data, which was reported in May of this year. Once again, the companies on the conference call said we're adhering and adapting to the regulation, and the fundamentals of the companies are doing fine. And as we enter into the Q2 earnings season for the K-Web companies, we're actually seeing the same thing. We're seeing that the companies are navigating and adhering to the regulation, and the company's earnings are doing great. In the case of, say, Alibaba, they grew almost 34% revenue growth year over year. And yet the stock is down, and that's just due to the uncertainty surrounding this regulation. So I think we need more clarity on what is the end game, what is the finish line, and we're starting to see almost the proverbial green shoots. We're starting to see that policymakers in China understand how this uncertainty has really weighed on the market, and we're hoping for further clarification that there is a finish line, and hopefully we're almost at it.
Okay, and we've seen net inflows from international investors regardless of the recent market turmoil. Can you provide 3 keys to consider upgrading Chinese stocks to overweight for a diversified stock portfolio?
Well, most definitely, Mauricio. One of the things that we're able to track is the activity of foreign investors in the Shanghai and Shenzhen stocks. We're able to gain that transparency through the Hong Kong Stock Exchange's Stock Connect program. So Stock Connect allows institutional investors such as Crane Shares to buy and sell stocks on the Shanghai and Shenzhen stock exchanges. That data of buying and selling is reported on a daily basis. Year to date, foreign investors have bought $40 billion of Chinese A shares. Now, taking 2020, we saw that there was about 30 billion. So we've actually seen more money invested this year in Shanghai and Shenzhen stocks. Those are the companies we own in our Crane Shares MSCI China A ETF KBA, that we can see that we've had more buying in those stocks year to date than all of last year. So including this year and last year, we've seen 70 billion of net buying in Chinese A shares. And I think that's due to that those securities are predominantly held by investors in China who have a positive view of China's economy and therefore are net buyers of stocks, as the good economy means good earnings. Those stocks, because only about 5% of their total ownership is held by foreign investors, they tend to have a very low correlation to global equities. That basically they don't act like, say, US stocks or European stocks or Latin America stocks. They kind of beat to their own drum. That what investors in China think is important can be very different than what foreign investors think. So low correlation is always a critical benefit for investors. And these Chinese Shanghai and Shenzhen stocks, the companies we hold within KBA, do have a very low correlation. So we think it's a combination of investors globally are recognizing the opportunity set in Chinese A shares by buying the stocks like we hold in KBA, and you get the added benefit of low correlation as well as strong earnings expectations based on China's resilient economy.
Okay, thank you, Brendan, for the call, for your time, and we talk to you soon.
My pleasure, Mauricio. Anytime. Thank you.